I plan on speaking very little about myself. I'm actually going to spend a lot of time talking about the past and a fair amount of time about the future. I just want to let you in on a secret. The future is now. So when I speak about the future, it's actually unfolding in front of us. Ben gave my introduction. I come from traditional finance. I spent 20 years at BlackRock, the first 12 years helping scale a really large risk management, portfolio management system. And then for the last 6 or 7 years, before I retired last June, led a digital assets team, which took our time to figure out what role can a benevolent fiduciary asset manager play in this new crypto ecosystem. And we did a few things. We invested in a company called Circle, which is the second largest issuer of stablecoins. We launched 2 of the fastest growing exchange traded funds in history. In 2024 on Bitcoin and ETH, they raised about $100 billion until the markets came down, and I think there's $70 billion today. And we launched one of the largest, I think it's currently the largest tokenized fund in the world. And I say this not out of a lack of humility. I say this because our goal was to raise standards in the industry, and it took us 3 or 4 years before we were ready. And the reason we took our time is it turns out if you manage money for pensions and retirees, you can't make mistakes. Because if you make a mistake, firemen and teachers don't retire in dignity. During that period, I went pretty deep down the blockchain rabbit hole. Got very, very focused on the Ethereum ecosystem, and I joined SharpLink, which is an Ethereum digital asset treasury company. For those who don't know what it is, think of MicroStrategy, which allows you to invest in Bitcoin by buying a public equity. We were the first digital asset treasury focused on the Ethereum ecosystem. We're the second largest. Last summer and fall, we raised about $3 billion, and we used it to buy Ether, the native token. We right now is about the past. We right now are really witnessing one of the most fragmented period in history around trust. Web 1 opened up the idea that anyone can exchange information, but you couldn't actually verify it, but we became reliant on it. Web 2 opened up transactions in commerce where you trusted lots of intermediaries. And I think what we're going to be seeing shortly in my conversation today is about disruptive technology and the convergence and what the new trust will look like in financial ecosystems, in technology, and in governance. And I think I would just posit, it's broken in societies. So when I use the word disruptive technologies, I don't use it pejoratively, like disruption is a bad thing. It's going to create levels of verifiability, finality, and frankly, prosperity like we've never seen in our lifetimes. And let me explain what I mean by that. I'll focus first on the use case of financial services, and think of financial services as a $700 trillion market of assets, stocks, bonds, real estate, commodities, and it today trades on infrastructure, I'll use the word rails, that are somewhere between 50 and 75 years old, and even through improvements, it's a broken system. And the only thing we know in life is that every human transaction requires trust. In today's world, that trust has been intermediated by lots of good peoples, exchanges and clearinghouses and counterparties who provide value, but the current system is completely fragmented around the world. How many of you go into banks today, Monday through Friday, versus transact 24/7 through your phone? Like, who transacts through the phone and who likes to go to break? Like, yes, the answer is clear. Financial transactions generally happen a few hours a day, Monday through Friday. And if a leader decides to declare war on a Friday night, you're stuck in your positions until the markets open on Monday morning. Again, that's not a pejorative point. And what that requires is trillions of dollars a year in human trust, contracts, and settlement risk, because you're usually waiting a day or over a weekend for your financial transaction to settle. If you go to Asia, it could be 2 to 3 days. You know, you have to wire somebody money, you don't get your security or asset until a few days later, and there are massive fees being taken out of the system. And when you face counterparties. If you're old enough, I've lived through 3 or 4 financial crises where your counterparty doesn't exist and you're left holding the bag. So when I talk about blockchain, it's not a technology conversation of a new technology in search of a problem. We have a problem, and let's talk about how it's going to be solved. At the end of the day, I think what I'm going to be speaking about today is the industrialization of trust. So everything I've said so far is the lack of trust in governments and governance, in technology, in information, and in financial transactions. There is a new trustware called the blockchain. You can call it the industrialization of trust for the first time in our lifetimes. That is going to change how money is moved, how we transact, how we invest, and how we interact in our financial lives. And there are 3 primitives, I use the word primitives, that if I was here 2 years ago, this would have been a crypto conversation. What are the primitives that were essentially relegated to crypto? There are 3 I'm going to talk about now. The first is this idea of stablecoins. The idea that today you get your payroll twice a month. Somebody has to wire your payroll provider the money 2 days in advance, and if you get it on a Friday night, you probably don't have access to it till Monday. Stablecoins you can think of as just tokenized dollars. And in the beginning, stablecoins had only one use case. If you wanted to on-ramp to crypto, you couldn't actually interact with a bank. You bought stablecoins, and that's how you on-ramp to own or trade crypto assets. Today, there's about $330 billion of stablecoins. They're not used anymore for that one use case. They're how you're going to get paid. They're how corporate treasurers are going to move monies between hundreds of subsidiaries around the world. It is going to be how cross-border payments happen. The reason is you can move $1 in an instant for no cost, and it settles with finality. The second thing I think will be much, much larger than stablecoins, and that is the idea of a tokenized asset. Today, if you want to own a mutual fund or a bond or a stock, you don't own it in paper form, but there's someone out there who's holding it for you, and you can only trade it during business hours, and it settles 1 to 3 days later. There are some assets that trade 20 days and settle 20 days later, like a syndicated bank loan. We're in the early stages of the tokenization of every asset. And what do I mean by that? And then I'll get to what's the benefit. Tokenization just means it's the same asset, a stock, a bond, a piece of real estate, but you own it in a digital format and it's transcribed immutably on a blockchain. And what that allows is for you to be able to access, trade, and do composable things with that asset that only institutions can do today. You can trade that asset, a stock, at some point very shortly, 24/7. You can take your stock of tokenized Tesla and you can lend it to somebody on-chain. We'll get to DeFi in a minute. You can borrow against it. You can use it as collateral. This idea that big institutions today, they manage their money 24/7, and when they own assets, they borrow and lend it to earn additional yield. That is solely in the preserve or the reserve of big institutions. Humans like us in the room are going to have an ability to do this and actually make more from your money and avoid all the risks we have today of your counterparty not being available, or on a Friday night, if a war is declared, you having to hold that risk until Monday morning. So Larry Fink, the chairman and CEO and founder of my former company, has made it very, very clear, and when he speaks, I think you should listen, all $14 trillion of BlackRock assets are going to be tokenized. It started with money market funds, it's going to end up being ETFs, and I think that's a very widely held view. The final thing is, great, you have tokenized dollars, you have assets that exist in a format that is tokenized, whether it's real estate or money market funds or stocks or bonds or funds, but you need a layer to transact in them. And that's what decentralized finance is. So these blockchain protocols have built apps, they built exchanges, they built swapping capabilities, they borrowing and lending capabilities, where you don't need to go to that standard financial intermediary to help you borrow, lend, and the like. And you take these 3 things together, and what you're essentially building is a new financial rail that is modern, that has embedded trust. And what do I mean by that? On the blockchain, using proofs, you can know who your counterparty is, even maybe without identifying them by name. You can know that the data you're transacting with is verifiably true, And when you transact with someone, it can settle in an instant, 24/7, and you're not taking that counterparty risk and delay. And then you could do composable things with your asset. You can borrow it and lend it. These are not crypto capabilities. Institutions have been doing it behind the scenes for a generation. And this should inure to the individual, not necessarily to the intermediaries who are charging rents, even though you will need trusted intermediaries. This is the industrialization of trust. And if you think this is going to be relegated just to the financial world, data is going to be verifiable. News is going to be verifiable, because you know what happens in Web 2 is that your social streams and your access to news have been weaponized. And it's very unclear what the truth is. It's whatever the algorithm presents to you. In the future, many things are going to be verifiable on chain. And the current users are human. And each one of us who raise their hands and says they transact on their phone or they go to a bank, it doesn't matter. It's a human interacting with their money and a human interacting with another party to get what they want. The future users are going to be human, and the future users are going to be AI agents on behalf of your humans. They are people who are going to understand your intent. They're going to understand your financial goals. They're going to understand your social views. And I think it's going to change how we manage money and how we interact in a way that we can't anticipate. And this is not the future. There were about 100, in Q1 alone this year, there were about 160 million AI agent to AI agent transactions, usually very small ticket sizes and numbers, fully on-chain, fully autonomous within guardrails. So this is not the future. I'll make a bold prediction. Does anyone here have a human twin? I mean, this is shocking and statistically anomalous. I think most people in this room in a year from now are going to have an on-chain wallet, not realizing it's an on-chain wallet, and your on-chain wallet is going to have a digital twin who can do things on your behalf within guardrails. So everyone will have a twin. It'll be called your agent. There's a huge debate. Is your agent the master or you're the master? I don't know, but in certain societies, you learn at the feet of your masters. I think we are going to initially empower our agents and we're going to be involved. Eventually, our agents are going to be doing things for us 24/7. They don't sleep. They can process massive amounts of information and they can execute your commands with fidelity. Humans make more mistakes than agents. Why do I say agents are going to matter? I think in most generations, even sometimes in centuries, there could be one mega force that changes society and how we live. It could have been the telegraph, it could be an automated assembly line, it could be the railroad system. I think we're in a moment where we're seeing a convergence like we've never seen before of 3 or 4 mega trends that are going to change our lives and essentially allow us to tokenize and automate a lot of what we do in our lives, both governance, technology, data, and financial services. And here are the mega forces that each alone would change a century. The first is just the idea that we have these on-chain primitives that I talked about. They're not relegated to crypto. Tokenized digital dollars, all assets are going to be tokenized. And rails, or a layer on which you can transact with finality, so decentralized finance, that alone can change financial services. But you also have a moment where you probably have the largest breakdown in societal trust in every society, financial, technology, information, and the like, that we've never seen, and it demands some sort of solution, otherwise our society can break apart. The third is something that we don't talk about, which is the largest movement of wealth in the history of mankind in the US. And it's called the Great Wealth Transfer. Over the next decade and a half, about $100 trillion is going to move from boomers to all of us in the room and our children. And it's moving to a group of people who don't go to banks, who don't trust intermediaries, probably don't want a 58-year-old, I'm 55, don't want a 58-year-old financial advisor who wants to talk about golf and goals. They literally trust code over institutions. And I don't know if that's a statement about code or a statement about institutions. And how many of you 4 years ago used AI in your daily lives? How many use AI in your daily life today? These are people who own some of the 800 million on-chain wallets that allow you to have crypto, but also tokenized assets and stablecoins. And this is a group of people who 2 years ago didn't use AI daily. Today they trust it with some human intervention. And then finally, the idea, if you have these new rails, you have a breakdown of trust, and you have an agentic capability with guardrails, it's going to change our lives. I told you there are certain capabilities that only the largest institutions have. Giant teams of people who make sure there's no idle cash. Who here has idle cash in their bank accounts? I bet you most people have it. They're just afraid to raise hands. Who here, when you put your cash to work, sometimes put it into a firm who offers you no interest? Well, imagine a world where there's an automated agent who has guardrails, who understands your capabilities. You get your paycheck, your money never sits idle, and when it moves, it gets market rates. Imagine a world where you own Tesla in a tokenized format, and your agent will lend it out, and you get additional yield. Imagine a world where you can step into governance over what you own. So the dirty secret that no one knows about is if you own a public stock, I'm a CEO of a public company, you get to vote a proxy every year to decide my pay, you get to decide my board membership, if we're doing a transaction, you get to vote. Institutions vote over 90% of the time on behalf of their clients and themselves of those proxies. They do it in an automated way. Retail investors, most of us in the room, less than 30% vote. And when you do, you have to get a piece of paper in the mail, take the stamp, make the choice to read it. Oh, and by the way, if you own the S&P 500 fund, what's the likelihood you're going to vote your proxy 500 times a year? 0. Your agent, if it owns a tokenized version, will re-empower retail investors to be able to express their views on all the things we've talked about. Without a stamp, all you need to do is give it your corporate and social responsibility views and policies, and it'll do the work for you. So this is fundamentally going to change our lives. I'm not here to shill my company. I'm not here to shill Ethereum, but I will tell you, after Bitcoin, which is a store of value and the first cryptographic decentralized network, Ethereum was next. This July, it'll be 11 years old, has never gone down, and it has tremendous trust. And there will need to be new rails, and I don't say a rail, there's not going to be one winner. There needs to be new rails on which this can happen in a verifiable way, in a decentralized way, because as people move to the new financial primitives, they're not going to want to be locked into one system, one database, one vendor. Ethereum happens to be that leading decentralized, what you could call a global computer, but in the financial world, we would call it almost a programmable global ledger. Like 52% of all stablecoins happen in the Ethereum ecosystem. Depending on some tokenization that's going to be announced, 50 to 70% of all tokenized assets are happening in the Ethereum ecosystem. And it has something that no other blockchain has. It has 900,000 validators of transactions who are staked and incentivized to make sure that the data's right and the transactions settle with finality. And it has a token called Ether, which you can argue is a store of value. You can also argue it's a trust commodity. And if most financial transactions in the future, human, machine, agentic, are going to happen on a decentralized platform, I'm talking about the future, and I'm talking about now, you need a trust commodity that's going to secure these transactions. We believe it's Ether, the native token. It's trusted, it's liquid, and it's probably the most secure chain ever been built, other than Bitcoin. But Bitcoin only does one thing: it stores and moves Bitcoin. It doesn't program money the way smart contracts can do. So I'm actually going to skip the Sharplink slide. I hope I'm setting you up to think of this as a new version of trust and a new version of financial and governance empowerment, and something that will help every single human being in the room. Crypto has a bad reputation, but you shouldn't think of this as a crypto conversation. You should think of this as a future disruptive technology conversation. And hopefully in the future, you won't think that you're on the blockchain. You won't even think of the blockchain as your UX. Who here watches a YouTube video and thinks, what cloud is streaming and supporting that? It's just going to be existing behind the future as infrastructure. So I'm probably over time. I want to say thank you. The panel is amazing. These are my friends, my colleagues, they're leaders in the industry. And I want to end by thanking Yale University and specifically Ben, who brought me here. I met Ben on a street corner in Seoul in September. No one should read into that. It was fortuitous. So thank you for allowing me to set the stage and talk a little bit about the future that is now.
Okay, I'd like to welcome up the panelists. So Joseph will also be on the panel. We had a great introduction to the topic. So Ali Harris. Ali is recently returned to JP Morgan as the head of their blockchain division, Connexus, and has had a long and storied career in this space. He was at JP Morgan before, also at Goldman Sachs, and has worked in this industry for a long time. We have Jörgen Ocknein here from Euroclear. Euroclear is one of the largest settlement systems and managers of collateral in the world. It's the European version of the Depository Trust and Clearing Company. And so everything that happens in the blockchain world looks very, very small to Jörgen, because if we talk about billions, that's small. They handle trillions. So, and of course, the same applies to JP Morgan. We have also Aaron Schnarch, who is the executive director of the Compound Foundation. Did I get that right? Right? And formerly was CEO of Coinbase Custody, as well as COO of Anchorage Digital, was at Broadridge before. So all of our panelists have worked at the intersection of blockchain technology, digital assets, and traditional finance for a very long time. So you're hearing from absolutely the premier experts who you should want to hear from if you want to understand how institutions are using blockchain technology and why this transformation is starting. So we had a great introduction from Joseph. What I'll start off by asking our panelists to talk about is institutional adoption of blockchain has been all over the news for the last couple of years. Now, from where each of you sit, what is actually driving this? Is it about potentially improving market infrastructure? Is it about accessing economically significant networks now that Bitcoin and Ethereum and Solana and others have reached economic significance? Is it responding to client demand? Is it regulatory clarity? Is it some combination of these? And which use cases are becoming real now? So I'll start maybe with Aaron.
Can everybody hear me?
Yeah.
Good, great.
Yeah, it looks like it.
Thanks for having me here and look forward to a great discussion. I often reflect about revolutions and how they become mainstream as we think about humanity. That came into play when we had COVID and, we all had our fears and it was a lot of anxiety. If you go through history, it was a movie that humanity has seen multiple times over the last even 100 years. And so as we think about introduction and scaling of new innovation, it's a playbook that has been seen multiple times over. And I'll just mention, for example, how credit cards became so ubiquitous. If you have nothing else to do on a Friday night, you might want to read a book about how Visa scaled, how diners started. And essentially, you will see that the beginning was fraught and a lot of distrust and greed, et cetera, et cetera. And so by this, trying to contextualize saying that what we have seen with crypto over the last decade or so, I've been in crypto since 2014, this is of no exception. As I think about the ability to take this technology and make it embedded within everything we do, I think it's a combination of three things. It's trust that Joseph has mentioned, it's distribution, and it's the user experience. And so as you think about regulatory clarity, that should help with trust as we make progress. I think we have seen quite a lot over the last 24 months, both in the US and globally. And we think about distribution, I think what you now see is financial institutions that are reputable and very thoughtful, trying to take the blockchain and embed it within services and businesses they already have. And so perhaps a retrofit, similarly to what you've seen perhaps with the internet before and then later on with the cloud. And then the UI, I think this is certainly something that people work hard on. I think that crypto is a phenomenal technology that has had a difficult and often onerous challenges of making it seamless. I still have challenges explaining what I do to my mother. My mom is 85. And so I think once we crack that code, we will see global adoption that probably would accelerate in great velocity. It's not going to be a linear process.
Jordan?
So I'll try to be more pragmatic. As you mentioned, Ben, we are an FMI, a financial market infrastructure. And just to give you a sense of the size, we have 45 trillion under custody. And every month we process around a quadrillion euro on our books. And I just mentioned the size because it's quite important. And for us, the debate, if you go back to the initial narrative about the crypto companies, they used to say a few years ago, thank you for your service. You're clear we don't need you anymore. It's time to move on. We'll manage without you. And fair to say they have been trying quite hard for a number of years, but they haven't managed to get there for one reason, maybe several reasons. First of all, you need trust. And surprisingly, Bitcoin was and blockchain was created to disrupt trust. And now people are telling us, listen, if we want to go from millions to billions to trillions, we actually need you to be in the mix because we actually trust you. Because our institution sits at the intersection of trust, scale, and regulation. And if you look at the narrative from the crypto native companies and everything that has happened so far, it started with disruption, then somehow kind of conversions, and now it's about how can we collaborate together. And we are a 60 years old company. We have, we were actually created by JP Morgan, to cope with the paper crisis back at the day. And we have gone through all the innovation and all the crises that you can imagine over 6 last decades. And it's just because we're able to adapt to what's coming next that we're still in business, and that's what we want to do today. But fair to say that for us, the biggest challenge is not necessarily the DLT it's the pace of innovation. It's moving so fast, and we have a responsibility of bringing the ecosystem with us that makes it a more synchronization and orchestration challenge between reg, tech, and value for clients.
Ali?
Yeah, sure. If the question was like, why are we seeing adoption now? Maybe I would think about it as like all things on a continuum. So on one end, asset owners and the buy side and large asset managers, I think you're seeing this trend towards distribution meets regulatory arbitrage in a world where you can move assets globally to anyone with a wallet, whether that's custodied or self-custodied. And I think there's been a tremendous amount of focus on, assuming that market structure stays the same, although personally I'm not sure it will, with like geopolitical uncoupling and non-US nation states wanting to create digital firewalls and fences. There's been a huge push towards the tokenization of everything because there's essentially new eyeballs and customers anywhere on the globe for your products. On the other end, which I would say is like the real innovation and the market structure, is I think Joseph had some great points around the potential of this technology to actually change market structure. And that's where it's actually been, we've been doing this now for over 10 years, and it's been quite painful and complicated because this technology is distributed systems plus market structure change where you need network effects if you're thinking about the incumbents from an innovator's dilemma perspective. So it's definitely a huge mind shift change for us to think about, like, where's the world going? How are our roles changing? And how do we actually think about, like, the business models so it's not just a technology for technology's sake. And so now I think 10 years in, we're in a really good place where we are seeing some of those benefits and scaling them. And again, that has been fostered by, the technology is now enterprise grade. There's a bunch of different, protocols and stacks and the tooling on top of it that you can use. But I would also say the regulatory clarity, especially as you think about public blockchains and public permission blockchains, especially for, bank holding companies like ourselves in the US. So I think over time, you'll see these worlds connect, where there are institutions and two-legged people interacting on the same rails, where you're collapsing, money assets. What is it? Money, no, it's value, information, and assets onto like one rail. And so I'm definitely super optimistic about where we're going, but it's definitely non-trivial. There's still a lot of work to be done as we're basically moving these businesses onto the new, market structure and rails, as Joseph was saying.
I really don't have a lot to add other than maybe a little bit of a human perspective. The industry, the crypto industry, the blockchain industry, I think has fallen into there's a Bill Gates quote, and they've fallen into the trap. He has a great quote, and I'm going to paraphrase, which is, we fundamentally overestimate as humans the pace of technology change and its impact in 1 year. And the corollary there is the crypto community has been saying since 2017 everything's going to be tokenized. But actually, the second part of the quote is humans really fundamentally underestimate the impact of technology and team change that can happen in 10 years. I personally believe that institutions are doing this for all the reasons you've heard. And I believe it might be the most impactful financial transformation since the electronification of the equity markets in the 1970s and 80s, which fundamentally transformed financial services. There is only one other thing I would add, and it's not a direct answer to the question, but this has a geopolitical element as well. In a moment, the question is, why is there so much U.S. momentum and regulatory clarity from this administration? You can have a skeptical view, but let me give you an optimistic view, which is, in a world where less countries want to buy U.S. treasuries, China, Russia, if we invade Greenland, Europe, this industry and the stable coins are all backed by U.S. treasuries. And you have a world where you have one of the newest, largest buyers of U.S. treasuries in the world, which are stablecoin issuers. I believe the two largest stablecoins, Tether and USDC Circle, are the 12th largest creditor of the U.S. government. And the secondary impact on that is that you're almost seeing a re-dollarization of financial services. If 99.7% of all stablecoins are dollar denominated, and they're the means in which a lot of financial transactions are going to happen, it becomes a geopolitical threat to other money centers, London, Hong Kong, Singapore, Seoul, and Tokyo. So you're going to see not just an institutional element, it's going to become a geopolitical accelerant. So I don't have a lot to add other than a different dimension.
Well, we've heard a number of dimensions here, and many of you also touched on, in fact, Jorgen in particular, the fact that this is, the original narrative around blockchains were that they were going to disintermediate traditional finance and remove financial institutions and replace them. I've been in this space for a long time, not on the financial institution side, but starting out as a PhD student at Stanford, and I helped build Filecoin, which was that was my part of my PhD thesis. And the whole narrative then was around Bitcoin and Ethereum and things like Filecoin, which I was working on, creating a completely new economy, right? And we've seen a shift over time now, and so. One thing I'd like to dig into a bit deeper and get your different perspectives on is, now that regulated institutions are adopting blockchain-based infrastructure themselves, right? Does that change the roles not only of the existing blockchain networks, but how does it change the roles of banks and asset managers and market infrastructure providers? Are we going to land in a world where the technology is absorbed into the existing financial infrastructure and it doesn't look at all like the original narrative? Or is there going to be some kind of equilibrium? What do you think? And especially from Compound, which started as a lending protocol that was supposed to replace, traditional lending, I think you'd have an interesting perspective.
So I'm going to share a story explaining how did I end up doing what I do. So first, I've been an institutional guy for all my career and have been through either servicing directly banks and asset managers or meaning on the custody side. And I think a watershed moment for me, as I was reflecting about this, was the introduction of the Bitcoin ETF that Joseph and I collaborated on a few years ago when both of us were in a different spot. And if you think about the ethos of what was Bitcoin, I think that you had trust list, finality, etc. as part of the white paper. I think one layer removed of that was interacting with that through a custodian, for example, Coinbase custody, BitGo, etc. And then if you think about what ETFs were, that is literally a second layer removed of the original ethos. And ironically, this is when it got scale. And so with that notion, I recently took something called Compound. Compound is essentially a category-defining leader of decentralized finance. Decentralized finance, in a nutshell, is the ability to transact, either borrow or lend, in between two parties that have no trust and might not even know each other. Those could be wallets. And instead of the traditional model where you would have a bank that would do the underwriting, etc., that could take 30, 60, 90 days and comes with fees, etc., you would have code. That code is called smart contract. And so Compound started with that notion, and I think it had huge market fit immediately, was very successful. And I came into this thinking that use case has been trying to grow for about 8 or 8.5 years, but we haven't seen that momentum building. And the decentralized finance, which I think is a great idea, still is a drop in a bucket as you think about global credit markets. And so when we looked at the numbers, people were providing incentives for increasing the book almost $500 million for a small company in the scale of a Euroclear. That's quite a lot. And I think that experiment has not been proven successful because if I asked by show of hands who supplied liquidity to a liquidity pool, and I've spoken to most Ivy League universities at this point, usually it's between 1% and 2%, and that's usually the person that invited me. And so what we're betting on is taking this technology, which we think is incredible, and latching onto existing distribution networks. So that could be asset managers, that could be DATs, that could be custodians, etc. And we feel that combination would enable that technology to get scale.
The way we look at this technology is it's basically an opportunity to rewire some of the things that we believe could be the next digital frontier. Basically, I used to say that the smart contract is going to be to the contract what the smartphone was to the phone. Imagine the phone at the beginning, you could call, then you could text, that you can move with it, and now you transact, you view, you entertain, you work, you do everything with that. And that's the spirit of which a smart contract and an asset is basically going. And that's changing significantly first of all, the rails you need to have, the way money and assets are designed are going to move, and actually the role you will play. So we look at it, from different time perspective. Today, in 2-3 years' times, and most probably later on, is that the direction of travel? Yes. Will everything be tokenized to the bone? Most probably that's somehow the direction of travel, but we have to bring the ecosystem together, and that's somehow the role we are playing. So if you think about the core nature of a central security depository, which is to basically make a delivery versus payment each time you do a trade, to make it very simplified, well, the chain does that quite well. You don't necessarily need that later on because you have the finality of the settlement, you have it's immutable, and it's accessible, and the transparency might be an opportunity and a challenge as well. But then you basically need to have the next structural infrastructure. What is that going to be? How do you access actually your assets on chain, and how do you transact? You need a wallet infrastructure, and when you put the regulation around that, you become a digital asset custodian. And somehow this is where you put the AML, the KYC, the trust layer, and the policy engine in it. And so the role is always shifting a little bit from doing core transaction to maybe doing orchestration, and most importantly, because it was mentioned here as well, there's not going to be one protocol or one layer ruling them all. So we need for our clients to be able to abstract the the complexity of the technology. And as Joe mentioned, when we watch something, we don't know whether it's streamed via AWS, Azure, we're just happy it's working. And so when you think about our clients, which go from central banks, strategic GSIBs or whatever, well, we want to make their life easier, whether it's traditional assets or digital assets. I don't personally am a big believer on DeFi versus TradFi, where it's all fi, it's just finance. So we need to make that experience simple, allow clients to use their money and their assets in a regulated way for us, in the way that they would unlock value. They want to have it 24/7, welcome. You want to have it during your normal hours, you want to take more time to transition, we'll create this optionality that will make your life easier.
Yeah, exactly. Totally agree. I would just use the word convergence, and that's what we're going to see over the next couple of years. And the convergence at the platform and infrastructure level is going to enable scaling at the app and utility level. So yeah, exciting.
I think all these large institutions will exist. I think I wouldn't want to be in the business of doing simple things for a high fee periodically. And I'll give you a great example. And I don't think it's just the blockchain. It's blockchain plus the primitives plus agentic. One of the largest exposures in all of our accounts is, we invest in the S&P 500. It's like a very common thing to do. Who here knows that there's a company called S&P Global who writes the rules, who gather the names of the 500 largest companies, rebalance it once a period. So they then charge the asset manager to create a fund called the S&P 500 fund, and that asset manager goes out and buys the 500 and a few times a year rebalances it for you. And then you have to go to a broker to buy it, to put it in your portfolio, and then you might have a financial advisor who, if they return your calls, will rebalance it once a month. If people don't think that you can build that financial product in Claude in a shorter period than my answer right now, for free, I think those are the type of businesses that, again, periodic, easy to do, repeatable, high rents, that I think will get disrupted because I think people can do it for themselves, or there'll be a fintech company that'll do it for a basis point, is my personal view.
Very interesting. So I teach a class on the technical side of blockchains, and I've been teaching that class for a long time. I taught it at Stanford before Yale. And so I've worked on the technical side. I have a blockchain infrastructure company. I've done research on blockchains from the perspective of how do you